inventory is a very important asset to merchandise operations. We begin to introduce the accounting for inventory in this unit. Here is the inventory equation. Beginning inventory plus purchases minus goods sold equals ending inventory. Let's go over an example and show it in an inventory ledger T account. Remember, inventory is an asset. For example, if we start with 8 shirts in our inventory that cost $10, the total would be $80. If we buy 12 more, it would be an increase of $120. Then, if we sell 4, we would reduce our inventory by $40, bringing us to a total of $160. As you note, we would have 16 shirts left. Let's show the accounting for the sale of merchandise. Here you have an inventory of 20 shirts that cost you $10 each. 20 times $10 equals the $200 inventory. You sell 4 of the shirts for $18 each. You need to make 2 accounting entries. The first entry records the sale, and the second entry records the reduction of the inventory. First, let's look at the debit and credit to record the sale. To show the sale, you need to increase the asset accounts receivable to show that the customer owes you $72. $18 times the 4 shirts. This is a debit to accounts receivable and a credit to the revenue account sales. The journal entry is then posted to the ledger accounts. Next, let's record the reduction in inventory. We sold 4 of the shirts that cost you $10. That means you must reduce the inventory account by $40. To record the reduction of the inventory account, you would credit that account for $40. The debit goes to an expense account called cost of goods sold. The journal entry is posted to the ledger account. As you can see, when the journal entry is posted to the ledger accounts, the inventory balance is now $160. The 16 shirts left times $10. Gross profit is a subtotal in the income statement. Sales minus the cost of goods sold equals gross profit. In our previous example, we would have resulted in a gross profit of $32. Sales of $72 minus cost of goods sold of $40 equals $32 gross profit. We use a ratio called the gross profit percentage to give us a quick snapshot. The gross profit percentage indicates the percentage of gross profit earned on each dollar of sales after considering the cost of the item sold. Gross profit divided by sales equals the gross profit percentage. A higher ratio means that greater profit is available to cover operating expenses and produce net income. Many businesses try to encourage their customers to pay early by offering a discount for early payment. They may use such terms as 210 net 30. This means that if you pay within 10 days, you get a 2% discount, but you must pay within 30 days. On the next slide, we will show the accounting for a sales discount. Here are the accounting entries to record a sale for $800 with terms 210 net 30 being made. The sale is recorded at $800 on the date of the sale with a debit to accounts receivable and a credit to sales. It is then posted to the ledger accounts, giving us an $800 balance in accounts receivable. The customer pays within 10 days, so they take the discount. $800 times 2% equals $16. Therefore, their check is for $784. $784 is debited to cash to record the amount received. However, the credit must be for the original amount owed of $800, as this is the amount that is paid off to bring the account balance to zero. The difference of $16 is debited to a contra revenue account called sales discount. The journal entry is posted to the ledger. Once the entry is posted to the ledger accounts, the accounts receivable balance is brought to zero. In this example, we show the accounting for a sales return. Assume a cash sale of 10 items for $100 each is made. The accounting entry to record the sale would be a debit to cash and a credit to sales for $1,000. Amounts are posted to the ledger. If one of the items is returned for a refund a few days later, a $100 credit would be made to the cash account to record the refund to the customer, and the debit would be to a contra revenue account called sales returns, sometimes called sales returns and allowances. Amounts are then posted to the ledger. In the past two examples, we have recorded two sales, $800 and $1,000. We had a sales discount of $16 and a sales return of $100. In the income statement, we would show sales of $1,800 and then show the items reducing sales, coming down to a subtotal net sales of $1,684. In many real-world cases, companies just show the net sales number.